Good morning, folks. If you would please give me an audio check. I'm checking Twitter for verification on audio. You guys should be hearing me. Thank you for that. Whoa, 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 whoa. Don't want to do that. Almost screwed up. One second longer. Hang on one. Okay, folks. The session will be recorded in case you can't stay for the entire duration, which won't be that long this morning because it's spring break right now, so the children are home. So I'm trying to cover this and get back to them. Um, that was the reason for the delay this morning. All right, so you can see obviously the dollar index. This is a daily chart. Beginning of the week, we were talking about the likelihood of the mean threshold on this up candle here, bullish order block. That being a potential catalyst for near-term resistance, which would potentially cause the market to roll over. And we were watching a couple different levels on the way down to just verify, make sure that there was not a continuation of new buying or a breakdown of bullish support levels or order blocks. And we can see that obviously every one of them gave way on the downside, and we've swept out the low here. And by having returned back into this larger daily order block, we still have yet to breach the mean threshold on this down candle prior to this big swing up. We know this down move here is the bullish order block. So until the price gives way below that 94.34 level, we still could see a bounce. Okay, so in other words, we have to weigh each price swing with levels of strength breaking down order blocks and supposed support resistance, because a healthy downtrend or a healthy down move should see very little resistance in the form of support, and obviously new resistance should be respected. So we still have some level below where we're at now in the dollar to contend with. Until that occurs, you got to still be reasonably expecting potential scenarios that could put the brakes on some upside on our foreign currency pairs. And we'll come back to the dollar in a minute. I want to look at the cable. And during this presentation this morning, we're actually going to talk about the yen, Aussie, and Kiwi times of day studies. I've failed to do that the last couple times. I'm not sure why I keep forgetting to do it, but I have. So let's take a look at the. Let's get a fresh chart on cable. All right, so we have the entire range of last week was completely filled in. All this range here, it's been filled in today, or as of yesterday, it's been completely filled in. Looking at a 1-hour chart, we're going to ask a couple questions. Now, I should have the chat window open on this live stream, but in honesty, I'm not looking at it, not reading it, because I'm sure there's some asshole out there trying to play comedy hour. But and it may not be true, but usually that's what happens when I open it up. So I'm not looking at that, but I'm asking questions rhetorically, so that way when you're watching the recording, obviously I don't know what your response is. I'm suspecting what it may be, but nonetheless, I want to ask you some questions as we go through the presentation this morning, and kind of like use them as points of reflection in your own analysis and your study. And then that way you can look at certain things going forward with these same thought processes. All right, so we have just looking at things naked as it is. And let's go back up one more time to the daily, because I'm going to get the high back here. And this is the one you've seen me tweet this, I believe it was this one, I'm not sure now. I might be speaking too soon, but going down back to an hourly chart. And for the bulls, we still are in New York. So if we come down and hit this level in here, 43.56, yeah, 43.56, we could potentially see a run off of that one. If it takes out this level and trades below the middle point of this, we're going to clear out the stops, and then the next level of business would be watching this one down here. Okay, preferably, I would not like to see this one give way, but if it does, the next level of support would be down here. Okay, and that's using an hourly chart on cable. Let's drop down to a 15-minute time frame. We'll look at time of day studies. Okay, really nice response off the order block here. And you're probably looking at this one saying, okay, well, this one didn't get hit. Well, the higher time frame hourly order block is not going to be subordinate. The 15-minute order blocks will be subordinate to the hourly chart, and vice versa. A 1-hour chart would be subordinate to a 4-hour chart, 4-hour chart subordinate to a daily, and so on. So having this, I'm also watching Euro on my iPhone as we're talking. So I asked on Twitter for those that watch my live streams and are available to be in them. I give commentary and ideas where I suspect price will most likely reach for, kind of like to help you frame a daily bias, or at least a foundation to it, because we understand that the higher time frame, daily and weekly and 4-hour, those types of time frames, they will draw price to specific price levels based on liquidity. And if we can understand what that's suggesting on those higher time frame charts, it'll give us a lot easier way of looking for trades, especially when they're defined by direction up or down based on those higher time frames. Because obviously on those higher time frame charts, it's not going to be noise that moves them. It's going to be real substantial buying and selling, and it's not by retail. Um, which reminds me of a question I remember seeing on Twitter. Um, the question is, or something to this effect. I think it was Chrissy. I think it said asked the question or made the point, and I may be wrong by the person saying, but it just hit me by talking about it now. The question is um, stops above or below a marketplace is ran, and it's taking out retail, but retail's not in the same liquidity pool, and to that effect, or something close to that. Okay, and basically what I'm saying is I've talked about this before, and it's pretty common, but yes, the banks do not see your individual stop. Okay, so when the detractors or folks that don't want to subscribe to the viewpoints we have, or at least that I have, they'll state that ICT is talking about something that's nonsense because the banks aren't interested in your stop. And I guess in the truest sense, they aren't interested in your stop because your stop isn't available to them. Okay, they're not. You're not the interbank market. Okay, UBS and Credit Suisse is not coming after average Joe. He's not even on the radar screen. Okay, but because every one of the retail traders are trading with the same concepts that are used in large funds. Okay, large funds are the whalers. Okay, they're the ones that are out there um, getting fleeced. You aren't, but you are in your own bucket shop retail platform, because the same things you're doing with your stop loss above or below the marketplace is the same thing the funds are doing. They're just doing it a little bit larger or wider, and they'll hold a stop on a higher time frame, swing high or low, where you wouldn't want to do that. You're trying to usually chase it on a 1 minute chart. Okay, you don't want to risk too much. But the same premise is there. Stop loss orders are um, essential for protection. Okay, especially if you don't know what you're doing. But the way I interpret stop loss orders is they're bullseyes. Okay, so it's going to lead the market to where everybody wants to buy or sell. And if a stop loss order is placed above a high, you know that's where the market's going to go. Why? Because there's willing buyers up there. So you're not taught that in the books. You're not taught that in trading webinars and seminars. Okay, you're taught that the stop loss order is your protection, and it is. I'm not stating or minimizing that, but it's important that you understand that the stop loss is exactly where the liquidity is forming. You're not the only one that sees that high or low, so therefore everyone's going to pull their orders all in one spot, which is where the idea of a liquidity pool originates from. All those orders are pulling. Okay, it creates a pocket of liquidity at a specific, known, obvious, logical place above high or below low. Okay, and that's what creates the market to want to move to those levels. Now, again, it's not your stop, but we're all collectively taught the same thing. Protect your stop. I'm sorry, protect your position above the recent high on a short and below a recent low on a long. It's simple. I mean, it's the same thing. We're all led to do the same stuff when we first start. But when you start to graduate away from that idea and say, okay, well, yes, when you're accurate in your direction, those things are there for peace of mind, security, yes. But the barest uh, stripping it down to its core essential, it's you making your equity, okay, or your position vulnerable because that's exactly where you want to take a loss. So you're a willing participant, okay? You're willing liquidity. You've done it yourself. You've placed it in the marketplace. So you're saying, I want to be a loser at this price. And same thing, that's exactly what happens with the funds. The funds will have their stop loss order above a recent high, okay? And the banks will muscle that price up there to hit that level. Once they hit it, they know the funds are going to cough up their guts. They're going to have to liquidate. And when they liquidate, it's not a little bit of retail trading volatility or in liquidity. It's a large, measurable, huge institutional level pocket of willing buyers. If they can run the stops on those recent highs, for instance, like we're seeing here, okay, like this old high here, funds, not that it's on a 15-minute time frame, but I'm just saying on a large time frame uh, chart. Let's assume this is like a daily chart. I'm already going on a rabbit trail, but trust me, we're going somewhere. The funds, if they're getting short, they're going to have a stop above this recent high, much like everyone else is taught. Okay, so the market will come all the way back up, clear that, and the large liquidity that's offered by funds, okay, will be absorbed by larger banking entities, okay, or institutions or large prop firms. They could do it as well. But long and short of it is, they run that because they want to take that liquidity and inject it as a willing participant. They want to buy here. Funds that have a stop above this high. And again, we're assuming this time frame is a daily chart, not a 15-minute time frame. But the same premise exists. If they're going to have a buy stop above this high, when they run price up, all those buy orders become market orders to buy. Why would they want to run those prices up there? It's not just to knock them out, it's to take their positions, and they're willing participants to be a buyer here. Think about it. If you had control over getting specific entry points that are going to be favorable to you, and you have a group of people walking around parading with signs saying, "I'm here. I'm gonna buy it from you. Sell it to me. I'm gonna buy it right here, and I'm gonna do it for a loss. I'm right over here. I'm right over here, right here. Come on, guys, come up here." And it's a rather simplistic and facetious way of explaining it, but it's exactly what goes on. Now, you're not getting targeted, but the highs and lows are, because that's where liquidity is. So when I say they're gonna gun stops, they're not gunning for mom and pop at you know FXCM. That's not what's happening. Now, your brokerage firm can be absorbing your liquidity with that same idea, because 90% of the time when you're trading against that house in their small little liquidity pool. And but the same premise is still there. Old highs and old lows, they are liquidity pools. They are essential targets for where the market is right now and where it most likely will be pulled to. Okay, direction on a higher time frame chart like a daily, it's really slow to unfold. But if you understand where stops are, where willing participants are in the marketplace with real orders, you can believe and have confidence that old highs and old lows, there are orders that are pulling around those levels. And if you understand what we teach here, the concept is rather simple. And once it gets to those levels, you'll know what to do accordingly. When it gets to this level here, do we expect it to continuously run straight on up north? Probably not, because we've already come off of a nice run. It's consolidated. It ran up a little bit, came back down. New York open, continuation, clears the high, and then gives up the ghost. Think about it. It goes on all the time. So hopefully that's answered your question. I apologize if it's not Chrissy that posted it. I don't recall exactly who it was, but I think it was that individual that was asking or commenting on it. But it's not your individual stop. They're not seeing you in your retail trading account, but the same ideas are prevalent with everyone's trading. Old highs and old lows is exactly where your stop's going to get placed, which is why I facetiously said back in 2010, I know where your stops are. I can see your stops. And it bothered a lot of people. They sent me emails like, if you can see them, how do I protect myself? Well, you use a stop to protect yourself. I mean, that's the only thing you can do. That's your only shield. But you have to know what you're doing. You have to know when to place that stop at that old low and at that old high. Because if you are doing it too early, you are asking to be fleeced. And the problem is once you get kicked out, you won't have the wherewithal to get back in knowing that you just got ran and it's still going to go the direction you thought it was. For instance, up here, I mean, how many people watch this trade up here, okay, and then come back down and think, well, if they were short, How many got back in right before it started to tank? Probably a large group didn't, and it would have been the winning opportunity to get short here based on its old high. And it's turtle soup. It's all it is. It's this turtle soup trading pattern that I've collected and adopted from Street Smart's book. Really, really, really good pattern. It's a bread and butter technique. It's basically one half of how I trade London Open. I mean, it's simple as that. It really is a powerful trading pattern. Uh, anyway, without all that ranting, we have excuse me. Let's pull up a. Okay, so now what we have is we've posted the range on the day, and what we're looking for is deviations on this. Okay, I'm going to try to keep the chart as clean as I possibly can. This is the last 2 days on cable. We had one deviation down. Four on the upside. Can't get any better than that. And then we had a profile you'll learn, or a template you'll learn, this Saturday, where it starts right out of the deviation and goes into there you go, you can see that, hit it. And I don't want to leave it all in there, but it'll start getting really busy. So you can see there is a method behind where the daily range goes. It's not a completely random thing. It's already going to be predetermined. And I know it's going to sound like it's something that's unbelievable. The market's too big to be that manipulated. It's not going to be programmed. It's not going to walk to a script. It's not going to follow an idea that's form fitted before the fact. But I hate to burst your bubble, but I've been saying this to you guys as far as it relates to foreign exchange since I stepped out in the scene in public forum in 2010. Okay, I've been saying it. I've taught it to folks individually. Prior to that, I've been teaching obviously since 1995, and I've been trading foreign exchange since 2001 as it relates to the spot market. So I there's a lot of the things that you're going to hear when you subscribe to me, and it's going to be problematic for you. It's going to go against a lot of the things that you're grown warm and fuzzy to. The markets are free. Okay, they're not manipulated. No one's out there to get you. There's no boogeyman, and there is. And I hate to say it like that, but there's no other better analogy than to break it down like that. You have to understand that there are entities out there that are malicious, and it's because that's their business. Okay, I mean you're gonna fault the guy for charging you for putting new tires on your car, and that's his business. It wasn't his fault that you ran over the nail or something that tore up your tires. Okay, it's a business transaction. Well, you're trading in their playground. So if you're going to be in here, you got to understand how they operate, how they thrive is to push price around. It's not just always to get you, okay, or get a fund. It's to facilitate free trade. It's also to establish business transactions that are global. They need to have movement and prices that are fair for corporations to work within. So again, I can vilify it and make everyone just turn their nose to it and say, well, this guy's it's all conspiracy theory and he's a whack job. But I do have a balance in the way I interpret it. But it makes sense for me as an internal dialogue as a trader. That's how I personify the market. Okay, um, you may not need that. You may look at it as it's 401k friendly, and get in there and buy and sell. You'll find out later on it's not, but you have to have some kind of basis point. When I first started trading, that's exactly how I looked at it. I looked at it as buy and hold, everything's going to be great in time, and it didn't work out well. It didn't work out well for me at all like that. So you have to be a trader. You have to understand what makes the markets move, what makes the markets go to specific levels. Okay, when they go to those specific levels, it's not because it randomly took place. It didn't just pull out of thin air. Okay, the market didn't say, well, look, let's really surprise them and go here. Now, you may feel that way when you're unlearned and you have no idea what price action's doing, and especially by the things that I share, because they're nowhere else. You're not going to see these ranges and the deviations and the building of the daily range anywhere else. It wasn't until the market maker series that I put on the InnerCircleTrader.com website, on that tutorial page, no one, no one was ever sharing this information before that. So 2014, 2015, 2016, all those ideas are completely and utterly unique to me. And you can get pissed off and get tired of hearing me saying it, but it is what it is. Okay, I get questions all the time. You know, am I doing this? Am I repackaging this and repackaging that? There's no repackaging of this at all. I mean, this is how the daily ranges are formed. No one else talks about it. Believe me, if this was known in the general public, this would have been all over Baby Pips. It would have been all over Forex Factory. It would have been everywhere. Okay, there wouldn't have been one place that hadn't been talking about it. 15,000 people would have came up with some kind of indicator plotting it. Okay, I mean, it would have been somewhere. Now the only place it's been has been in my charts. That's where it's been. And I've been doing it for over 10 years consistently, building a really strong idea on how I took the information I learned from institutional aspect and what I knew from my own retail trading as a commodity trader and stock trader. And when I saw those things, I dovetailed a lot of ideas because I don't have a program that plots the high and low the day before the fact. I have to weigh things as the day progresses. Now I can have an idea once this range is established. Once this last candle closes on the day, okay. Once that occurs, I have now the building blocks to formulate where I believe the daily range is going to form. Okay, and this is why I try to tell everyone you're going to have to work your ass off to get the level of precision that I show, because you're not going to have an indicator just plot something and all of a sudden you're going to know right away. I already told you there's 6 templates. Okay, 6 intraday templates that I use. Okay, you're going to see that if it's going to be a bullish day, there's 6 potential scenarios that may unfold. Now, does that sound like easy peasy? No, because you're going to have to weigh some things. You're going to have to think about things. You're going to have to use that gray matter between your ears. When you understand the things I'm suggesting and talking about, you're going to be able to take these concepts and build the understanding of where the algos on the interbank level, where these prices are coming from, right from the central bank. Okay, it's kind of like hacking the central bank. It really is. I hate to say it like that and sound like someone that's doing something illegal, but this is absolutely legal. I mean, you can't take this information, okay, and build it like I'm doing something illegal. I mean, it's information that you're all getting the same information basically. It's the open, high, low, and close. Okay, we're all seeing the same data, but there's going to be a deviation from where your high and your low may be on the day because of the data feed. There's going to be a little skewing on that, and that's the problem I have with folks that learn my stuff, even the folks that sat down with me one-on-one, they paid $20,000, okay, to sit with me for a week, and I taught them this stuff. The biggest repeating thing that came up was there isn't this exact precise range where if I show it on my feed, okay, their feed will be off by 3 or 4 pips, and they make a big deal about that, forgetting the fact that you're nailing down 95% of the daily range before the fact, before it even unfolds. Okay, you can't expect perfection. Now, when I say precision, the last time I checked, precision doesn't equate to perfection. It doesn't give perfection. There's going to be a model that you have to adopt in your own trading. When you're going to be able to take these trades is going to be highly selective. Okay, I don't trade every single day. When the positions that are offered give the majority of clarity that you'll learn about this weekend with the 6 templates. You get 6 templates that you got to follow when you're bullish. You got 6 templates that you got to look at when you're bearish. So there's, even though you have a daily bias that may be bullish, there's 6 scenarios that you have to weigh out, and 2 of them could potentially kick you on your ass. They start off right, and if you're not nimble, you can end up losing still in the day. So that's why I tell you to take some partial profits once you get some range expansion into New York. Pay yourself something, get something out of the move, okay? Because it could ultimately have a reversal market profile, and we'll talk more about that. It'll be very specific. You'll know exactly what it looks like. It's an idealized, conceptualized view of every individual intraday template that can potentially form, and it's all time and day built, and the scenarios that takes place. Now, when you start studying it, you won't see it. You won't see it right away, but you'll see the clear buy days that are one-sided. You'll see the sell days that are really one-sided. You'll see the market reversal profiles that take place in New York that are really easy to see. But the other ones are a little bit more, they require a little bit more study, okay? And you'll grow into those. But I promise, when you see these things and understand what we've talked about here as it relates to the flout, the central bank dealers range, and expansions on these and deviations from these ranges, when you have that, if you look at the higher time frame charts, then with that understanding, you will start seeing trades that you never saw before, and you're going to have all kinds of newfound confidence. Because now it's important to understand that the newfound confidence is not, it's not meant to be overconfidence. I don't want you in here trading more than you need to be. Again, I'm like the father of this stuff. So if it's my stuff, and I'm not trading every single day, why should you think that you should be doing it too? You shouldn't be. Don't go in thinking you have to take a trade every single day. If you have that sensation or that impulse to do that, you're emotionally driven. You're not objectively trading. Okay, these tools are absolutely killer. They are killer. But like anything else, if you torture the numbers, they'll confess to anything. They'll tell you there's a buy signal if you twist them hard enough. So it has to be a balance. Okay, you have to have it where it's set up so strongly in your one favor that the market wants to go higher. If it wants to go higher, start plugging in all the bullish models and profiles and templates, and it will be just like, it's exactly what you're looking for. Let's just put it that way. It's not perfect. It doesn't mean you're not going to have losses. You are going to lose money. You're not going to lose very much, but when you're right, it is astronomical. It's like the best thing you've ever seen in terms of trading. And what's nice is it doesn't require any kind of indicators except for understanding the range that we've shown here and time. That's it. There's no Fibonacci. There's nothing except for an up and down closed candle. Moving away from that level, you're looking at price only. That's all it is. There's no moving averages. There's no indicators. None of that stuff. There's no support resistance lines. All you're doing is identifying where liquidity pools are, where fair value levels are, and the order blocks. And how far away will that daily range move up or will it move down? And it has nothing to do with the average daily range. It's all in this range here. This is what you've been looking for. This is exactly what you've been looking for. And what's the cool thing is, once I learned that this is where it was taking place in charts, all the things that I was spending 350 pages, okay, understanding position building. That's what they were trying to teach me. And I got a real short attention span, and I'm looking at this stuff, and I'm like, I can see sometimes these events taking place in price, but I can't find a way to formulate a consistent approach to seeing it so I can harvest opportunity. And then one day, looking at things in price and looking at how the daily ranges are formed, it wasn't until I was actively trading the spot market that I saw that because it's a 24-hour market, if you look at the sessions, we have the London session, we have the New York session, we have the Asian session predominantly. And when I was looking at it, I saw that there was that small little consolidation that takes place before all the action. And it hit me that all of these things that I was learning, okay, how to do from the institutional side, were all being formulated in this time of the day. So the idea is this, okay, without going into any more because I can't get in trouble with what I'm about to say. I think I have to put borders on it and can't go past certain boundaries. But I realized that if my understanding that started with Larry Williams with an up day, the open will be near the low of the day and the close will be near the high of the day. And for a down day, the open would be near the high of the day and the close would be down by the low of the day. The question is how long does that daily range expand? Intraday. Once you have a directional premise, how far does it reach for? Why is it reaching those levels? What's making it go that far? It's not every one of us buying it, okay? Because again, retail's not doing it. So what is it doing? It's expanding, reaching to counter liquidity because the daily range is already engineered early in the day before the actual Frankfurt opening. It's already pegged. Believe me, it's that manipulated. I can't say any more than that, but it's that manipulated. The daily range is already noted how far it's going to go. Now, years ago when FX was just coming on board in terms of popularity, we had bucket shops, and the highs and lows would be whipped well beyond what the interbank price was, and it had to be it had to have some kind of regulation. And in the states, we had CFTC now, Commodity Futures Trading Commission. They got their hands in it, and while I wasn't really excited about them being a part of that, when they started enforcing, I'm glad they did because it's done a lot in terms of keeping brokerage firms from really doing some really ridiculous things like we saw early on in FX. So when it was deregulated, it was like the Wild West was there again. Cowboy traders would be able to come in there and do crazy things, and brokerage would be able to open up a bucket shop and do simple things to take your money from you. It's not nice to see 50 pips expand beyond what the interbank high was on US CAD, and it goes 50 pips above the high just to get your liquidity because they know they can do it and you're going to get knocked out. That's the kind of stuff that was going on early on. So thankfully in the States we have a lot of brokerage firms that have regulated and stepped in and caused some things, and FXCM was one of them. They were one that were hit with certain things like that and had to pay in my opinion, too little of a fine. They should have been fined heavier than that. But nonetheless, we have an ability to you're not beating, okay? This is some of the things, and one of the guys that learned from me, okay, went out and started marketing stuff, and you beat the market maker, okay? You're not beating the market maker, okay? You've heard me say this before, and I'm going to say it to you, or further sick of hearing about it, but you're never, ever, ever, ever beating the market maker. The only thing you can do is get in line with them. You get in sync with them. Okay, I'm not trying to teach you how to beat the banks. You're not beating them. Okay, because if I was beating them, I would never take a loss, and I take losses. Sometimes I'm going to read the information wrong, and that's exactly what's going to happen to you. Okay, don't believe the hype that comes around, especially following on Twitter, and sometimes the diatribe that happens to come from my mouth, okay, when I'm talking, okay, because sometimes I'll speak very grandiose and egotistical, and for the most part, it's warranted because there's nobody out there like me. But nonetheless, I still have losses, okay, and I'm going to read it wrong, and you're going to do that too. So there's no shame and no harm in doing that because obviously we're all human. We're going to do things and build this idea that's going to be one way, and it doesn't unfold. And that's the benefit of, you know, having the stop loss at the right place, because if you're wrong, you're going to be able to protect your protect your position from losing a larger position of equity. So now looking at these ranges, okay, when you identify the market that wants to go higher, okay, we've built the idea on the dollar back here. Let's go back to the daily chart real quick. We had ideas suggested that we moved back up in the beginning of the week. We moved in the mean threshold of the the dollar. So therefore, the cable and fiber, if this rolls over, is going to have a clear shot to move higher. Okay, so now right away, the premise is you go in looking for clues, looking for indications that does the market find support? Is there buying going on? How do we identify buying in the fiber and cable? You're going to see rejections below short-term lows, and once it blows those lows out and it runs north, what is that indicating? It's indicating that they have taken liquidity out of the marketplace in the form of what? Stops, sell stops. Why would they want to take sell stops when the premise of the market is down dollar, higher fiber and cable? Well, if the stops are cleaned out below the market in fiber and cable and it runs north, they have just tipped their hand and shown you what? That the bias that's arrived at looking at the dollar being weak, there should be northward pressure, okay, or buying pressure, okay, or higher prices in fiber and cable. The way you further quantify that is by looking at new formed order blocks that are bullish. In other words, down candles. Okay, once the price starts to move up and you have these sharp advances higher in fiber and cable, you want to see price respect those down candles. You want to see them trade to the top of the candle or down to the opening price, or no less than 50% of those down candles. That's the mean threshold. So there's your procedure you go through, okay? And you look for these phenomena to take place, what, any old time of the day? No. London open kill zone, New York open kill zone, even London close. Now, for the topic of Asia, which we'll close the session with this morning with when we talk about Kiwi, Aussie, and Yen pairs, if you're going to be a trader in the Asian market, which I don't do a whole lot of, okay? So you're going to hear very... And that's another, I hate to say it, but that's the real reason why I've avoided it, because I can't stand Asia. I know when I show you this today, I'm going to get a million things sent to me in email, a million direct messages, a million tweets about Asian market setups, and I'm just not really excited about them. I just don't care about them because they're still within the flout. And when you're trading inside the flout, it's just not, in my opinion, what I'm looking for. It might be exactly what you're looking for. It might be your bread and butter thing because you're a North American trader and you have a 9 to 5 job. You can't really be in front of the charts. It might work for you, and that's great. If it does, great. But I'm not inviting you guys to send me a million things. I already get 1,000 emails a week asking for, my suggestions or confirmations on setups. I'm not an oracle. I'm not going to filter your trades for you. So please, if you're thinking about doing that, or if you've done it and you've been ignored, that's the reason why. Okay, I'm just not going to do that for you. And besides, I can't do that. I got a life to live. I got to be on live streams and Twitter all day. So let's go back over to our cable chart, and we're going to look at some things. And let's go back over here and take this. So what we have is the way we define our day. We look at the flout and we look at the previous day's range, and we mold this with the idea that we arrive at on the US dollar index. Now, if the US dollar index is poised to go lower, as one of the potential scenarios that we were looking for to unfold this week, obviously we would look for what? The down move initially below the flout to take stops. We would look for short-term lows to be violated. We would look for new bullish order blocks to be formed and then respected. And we would look for range expansion on the upside. Okay? And we would measure the deviations on each day above or below based on that assumption. So this is why I'm telling you that a lot of you are all excited, like I'm going to give you something that's going to give you the high and low of the day from jump, and you're not going to have that. Okay, a perfect example was the other day where fiber went up. Okay, it went and we're going to look at it in a couple of minutes when we look at fiber. It went up. I think it was 4 deviations, and one more. I think did a 5th deviation, and then right to the pip, and that capped the daily range. Um, that's what you're going to do. That's all part of position management, especially as it deals with my tools. You'll have ideas how far it will reach for, okay, and that's why you have to take profits at these predetermined levels, because even though that we have these ranges expanded in our charts over the course of the day, they don't have to trade there. Remember, we're trading in most of us are trading in retail data feeds. So what I'm seeing on the interbank feeds aren't always jiving with what I'm seeing in FXCM, or if I see in Olanda, or if I look at another trading platform that I'm not going to talk about that I'm helping my sister with. The they're not jiving. They're not lining up. Okay, it's not so much that it's scary, but if you're measuring certain things like I teach, it's going to be a little bit of a misalignment, and that may be problematic. And unfortunately, there's nothing I can do to overcome that, which is why everyone asks me what broker do I use. I don't tell you a broker I use. Okay, I don't advise anyone to use a broker, because number one, I'm not an introducing broker. I'm not trying to drum up business for anybody. You have to do your own research and determine who the right broker is for you. I mean, that's the end of that. But I can tell you that you know it's not enough for you to be that scared of. Don't be that concerned about it. So let's go in here and take a look at what we have. We have the this is a 1 hour chart. Why did I hit that on here? Okay, so we have Thursday's trading, Wednesday's trading, Tuesday's trading, Monday's trading, and Sunday going into a new week. We look at the ranges in here, okay? We know that Tuesday and Wednesday, if we're bullish on the marketplace, those are the best days to be a buyer. So if we're bearish dollar, we're looking for buy scenarios on Tuesday and or Wednesday. It can occur on Monday, but generally I like Tuesday because I think that's the weekly range high and low. If you look at the charts and price action, it'll prove it to you without much time at all studying it. But we have the flout in here, okay, and all you do is expand or send 1 deviation lower, okay. Now on this feed here, the low that's projected, okay, is a little higher, but it goes down a little bit lower. Now, are you going to lose your lunch over that in terms of how much it moved lower? No, you're not. You're not going to be upset about that, because you're looking for a larger magnitude move. Now, a larger magnitude move on the daily range is going to be essential for you to have the amount of movement in terms of price actions you need. We're not teaching scalping here. We're not giving the idea to get in here and get 10 pips and be happy with that and run along and be, sharing it on forums. It's not what we're teaching here. I'm teaching you how to get the daily range, the whole lion's share of the daily range. Now, the traders that are more astute, they understand that they don't want to be a day trader, but they want to use these same concepts to go in to nail down one shot, one kill setups for the week. They can use this same phenomenon to get in sync with that, buy into it, and then hold it for a couple days and wait for the range expansion on the weekly chart. Now think, don't limit yourself. Okay, don't limit yourself just to being a session trader. Like, don't go in London and get out at New York and say, okay, I can't handle it anymore. I got to get out because I can't be in the market long. If you're fearing that, or if you're feeling those problems, especially if you have a profitable trade, I mean, you probably have experienced that this week, where you're getting in and you have profits, and you don't know when to get out. You lose all concept of what it is that you're supposed to be doing. Forgetting time of day. Okay, you're forgetting the range expansion that's expected in the day. You're getting 20, 30 pips, and you can't stand it. You got to get out because you want to get paid. Don't do that. Okay, I understand you're going to want to do that, and I went through all those types of things too. But The only way you're going to see the results that you really want is you have to submit to that time. You have to submit to it. And it means once you have an idea formulated based on a bearish dollar, if you're bullish on cable and fiber, Tuesday and Wednesday, you want to really be focusing in on buys. I have preached this hard and fast for years, and no one takes it to heart. They all still want to trade every Monday, every Thursday, and every Friday, and do very little on Tuesday and Wednesday. And I'm thinking because they're so afraid of being wrong, they wait to see the Tuesday and Wednesday buy, okay, and then they'll trade Thursday and Friday because they think the weekly low is in place, and therefore there it is. But if it's been a huge move on Tuesday and Wednesday, the weekly range is pretty much fulfilled. So it gives you very little movement on the other side of Wednesday. These are all parts of the templates that you're going to learn about, okay? But don't feel like you got to get out with a couple pips and the daily range is not yet fulfilled. I mean, if you're in a winning trade and you're long from London or New York and it's still going up and it's not even 10:30 in New York time, I'm sorry, 9:30 in New York time, you still have time. You have time for this range to expand further. You have to take that consideration, into your trading. You can't just go in thinking, okay, I made what I'm comfortable with. I just want to get out and feel good about it. If you feel that, take half the position off. Put your stop at break even, and then take the rest of it, and just don't even look at the charts. Set your alarm clock on your phone or whatever for 10:30 in the morning in New York time. New York time. I'm taking everything in New York time. If you do that, you come back to the charts, you're going to find out that had you kept your full position on, okay, and didn't take anything off, you'd be a lot happier than you are now because you're going to see that the range expanded even further, okay? So let's talk about algos before we go into this Tuesday setup here that took place, so that we can help formulate what you're doing every day, every week, what you're doing as a procedural way of doing things, because everybody's asking for, give me a way to do this consistently. It's all hinged on all these ideas, okay? And because of certain phenomena that takes place, you're going to have to go a certain route in that routine. Because think about it, there's 12 potential scenarios, 6 buys, 6 sells. So if I can't just give you a one shot, one kill concept, it always works this way, therefore, this is how it's done. I got to give you the opportunity to see conceptually how the markets usually, not always, usually pan out. And you're going to see there's a huge probability of that specific template fulfilling right in the same fashion. You guys can see market maker buy profiles now. You see them all over the place, okay? Once you see them, you can't unsee it. You'll know it. Well, once you learn these 6 templates, you'll know exactly what the daily range is doing, because the algos operate in these same structured ways of drawing liquidity into the marketplace or neutralizing that open liquidity. It sounds like science fiction, but I promise you, you're going to see it in the charts and you'll know exactly what you should be looking for. Now, again, I have to preface it by saying you are going to do it wrong. You are going to do it wrong. Do not assume because you do it wrong that it doesn't work, because it's not going to be proven to you the first next week. You're all going to be scrambling to use every single one of them next week. I already know what you're going to do with it. I already know what you're going to do with this, and you're going to be rushing in there and you're going to lose money. And you're going to see what I saw I saw 2 guys post this week on Twitter in grief that they're struggling. Don't do that. Not because I feel like it's going to mar my image, because I've done enough of that on my own. I do it for sport. Just look at my FX. I don't want you doing that, because what you're doing is you're fueling poor thinking. And if you say, and you put it in Word format, you're actually taking time to type this out, to put it out in the whole world, that you're never going to be able to do this. Well, guess what? I believe you. And everyone else that read your tweet believes that too, because you've already said so. You've committed to the idea that you're never going to do this. You said it in your own words. I'm never going to do this. I'm never going to be able to make it in this business. I'm never going to be profitable. That sounds like an absolute mindset, doesn't it? Well, if you find yourself thinking like that, you're screwing yourself. Not anybody else. You are. Don't think that way. Now, there's going to be times where you feel that way, okay, but don't
give it strength and power by saying, okay, this is how it's going to be for me always, and then look for everyone else that agree with you. Nobody. I mean, unless you're a troll, no one's going to come out and say, "Yeah, you're right. You're schlepping through these charts for no reason. You might as well just hang it up." No one's going to do that. Okay, but no one else is edified by you doing that. Now, if it's a reach out for help, I'm doing that now by telling you stick with it. I promise you, if you just dig your heels in, this stuff will start clicking for you. And if you knew the time it took for me to grind through this stuff, see, y'all think I woke up and knew this shit the next day. It didn't happen like that. It did not happen like that. And it's not going to happen for you. So just submit to it, okay? You're going to get there. Just relax. And don't expect your near term success to define your longevity. You need to have periods of growth and then some adversity, because you're going to learn in the adversity. Then you're going to have periods of growth. Then you're going to have newfound adversity, trials and tribulations. You're going to have those things, and that's going to shape you as a trader. So don't get pissed off and cry about how you can't do it well right now, because all of us are going to have that. I still get that. I was talking about US CAD potentially going up. It went straight down. If everyone hinged their idea just on that, because I talked about it in Sunday's video, of course, yeah, you'd have all kinds of material to run with. But that was just one scenario. The ideas are you're going to frame your setups based on certain premises and certain ideas and concepts. And if it matches and lines up, you have a high probability setup. That's not the same thing as a perfect lead pipe cinch, never going to lose any money, no drawdown trade. They don't exist. That's a unicorn. They don't exist. So, off my soapbox. Tuesday and Wednesday, if you're bullish on cable and fiber, they are your two best days. You are not looking forward to trading on Thursdays. You are not looking forward to trading on Fridays, because if you look at things on the conceptual basis of a weekly range, Thursday and Friday is kind of like the last part of the daily range. Everyone's in a rush to make money. So are the banks. So are the large institutions. So when Tuesday and Wednesday comes and the premise is already built into the marketplace and they get a feeling for what they want to do, the market starts expanding. Tuesday and Wednesday, if you look at the analysis over time, study a weekly range. Pick one currency pair, study it, and then really go crazy about studying, crunching the numbers. You're going to see about 65% of the daily range is usually formulated between Tuesday's London Open and Wednesday's New York Open. Now, by itself, doesn't probably mean much to any of you. But if you start looking at what that means as a relationship to the weekly range, Tuesday and Wednesday pretty much posts 90% of what you're looking for opportunity. Screw Friday. That's an extra. You got a long weekend every week. Only time you see me in the marketplace on Friday is when I'm either trying to show off or I'm talking to you guys. I'm generally not doing it because I've done something on Tuesday and Wednesday and probably on Monday. Now, Mondays are going to be good for you, especially if you have FOMC. If you have interest rate stuff that's in the middle of the week or on Thursdays, okay? Or non-farm payroll. We have non-farm payroll the first week of every month, generally. First Friday of every month. So you want to do what on those weeks? You want to be getting your trading done early in the week. Monday, Tuesday, second half of Wednesday, you want to be out. Reason why is because there's going to be a drying up of liquidity, and folks are going to be moving to the sidelines, and institutions are going to go sideways. They're going to hold prices generally in a range because they know that non-farm payroll, that carnival ride that everybody wants to be a part of, they're going to be wanting to be a buyer or seller ahead of those numbers, thinking they know something. All those liquidity orders above and below the range that's established in Wednesday and Thursday, that's what gets punched through on non-farm payroll release. You've seen me do 2 months past, okay, this year, live trading, recorded it, called the market moves before it happened, did it in non-farm payroll. You see it happening. Just because I know the probable scenario in there doesn't mean I'm taking live trades. I'm not trading it just because I can. It doesn't seem to me worth the risk. It doesn't make sense to me. Okay, I don't trade it. It's not for professionals. That's how I feel it. Non-farm payroll, NFP, not for professionals. You are not going to carve your living out career-wise trading non-farm payrolls. They're fun, they're exciting, they're neat to watch, but don't trade them. But use those weeks to know that the highest probability setups are going to be Monday, Tuesday, and the first part of Wednesday. By New York session of Wednesday, you generally, if you haven't made your money then, just get the hell out and watch the rest of the week. Trust me when I tell you, if I would have done that, I would have saved myself a lot of losses trading on the first week of every month. I learned that lesson the hard way. I'm telling you this so you don't have to do it. But you're not going to listen. You're going to do your own shit and you're going to lose money and you're going to think, and I remember him telling me this, and you're going to do the same thing everybody else does. Learn from pain. So love it. It's a sign you're alive. So now Tuesday and Wednesday we're bullish. Why? Because the dollar's bearish. Why? We talked about it in videos. I'm not going to go over that. So here's Tuesday. We have the flout in here. So you expand the range down. Why? Because you're looking for it to move down. How far will it go down? About that far. Right here. Okay. Notice it does not go all the way down to this order block. Wow. That's interesting, isn't it? Well, look at what you're looking at right here. On this chart, okay, on a larger scale, this is a market maker buy profile. Okay. Down here, smart money reversal. Low risk buy. Tuesday, we are in reaccumulation. Consolidation over here, distribution, redistribution, smart money reversal. Okay. If you're going to have a reaccumulation you're on the buy side of the curve now. In other words, you're on the right side of the smart money reversal down here. So the market maker buy profile kind of acts like an inverted head and shoulders. Okay, so you got to go through, look on the left side of the smart money reversal, okay, and see where the buying was over here. See that? So we have an area where there's a consolidation right in here. Take this consolidation, arrive at equilibrium, and extend that through time all the way over here, right in here, and that's where you're seeing reaccumulation. That's the reason why it's dropping down, because you're going back over here and recapitalizing an old order block. Okay, you have to cut through candles, you have to go through some things, you got to look at things where there was real buying before, because we understand that large banks, large institutions are going to buy early. They have the deep pockets. They can do that. You cannot do that generally because you want 10 pip stops. They're not trading with stops. They're averaging in. So they're buying in here. Okay? And they're buying some more in here. And they're buying some more in here. And they're buying some more in here. And they buy some more in here. And finally, the cap is taken off. It expands. It comes back down. They can buy in some more. Right in here on this order block. Cutting through candles. Okay? Down candle here. Extend that out in time. Bang. Smart money reversal. Low risk entry. Expands at the beginning of the week. Boom. Takes off. Now, we are inside of the early side of the accumulations of the market maker buy profile. So you're in an area where they already started hedging in. So now what are they going to do? They're going to add more because they've returned to an area where they bought. They come down, one deviation down, time of day sensitive, London open. Range is going to do what? We're looking for the range to expand to the upside. How far, Michael? How far is it going to go up? How are you going to be able to call a daily high, from here? What you start doing is, okay, and I'm going to give you one hint at the template. On one of the templates, because I've already shared this one before anyway. It's the buy day and the sell day, which is the low made initially with one deviation of this range. One deviation, 2, 3. That's the standard. Now I have this in your notes, okay, but you'll have this actually in a PDF file also. But it's going to be a standard deviation buy day. This is what this is. Now, a standard deviation buy day is one deviation down, creating the low. Then you have 3 deviations above the flout. Okay, and the same thing with central bank dealers range. We'll get into all that this weekend. But what this is this is called filling the numbers. Filling the numbers. Okay, so you have one deviation and then 1, 1, 1. So it's 4 deviations in total, not counting the one in the middle. That's just your reference point. So you're going to have 1 down, 3 up. 3 deviations above, that's where you're going to aim for. Okay, you're going to aim for that. You do not know. You do not know if it's going to go beyond 4 deviations generally until time of day starts to unfold. When time of day starts to unfold, when we start getting into 10:30, and we're sitting here, okay, around 10:30, it falls off precipitously that you probably capped the day on the daily range. Now, if it's trading in this area here, in this third deviation above the flout, once it's into this area here, and it's 9 o'clock in the morning New York time, okay, you still have time in the day. There's still battery left. There's fuel in the tank still. So what you're going to do is you're going to add one more deviation to it. Boom. Perfection, precision, ICT, baby. This is going to be driven by volatility. Now, I mentioned earlier in the week when we were doing live sessions that when you're going to be able to call the high and low of the daily range, it's not because it's voodoo. It's what the algos are doing at the interbank levels. These things are all computer driven. It used to be manually, but now everything's so technologically advanced that it just runs a script. Okay, and the only thing that's going to be a problem for you is applying the volatility filter. Okay, and I'm going to talk a little bit about that now. Is there a large probability for a big range day today up? Or is it been up for a long session of maybe 2 or 3 days up with big ranges? What's today's probability of having a big up day? Not high. Okay. What ends up becoming is you have to watch the templates that cause mixed price action. Okay. Or reversal. Now it starts to get interesting. We had what? We had the smart money reversal, low risk buy, reaccumulation, big range day on Tuesday. Okay, we have traded back up into the consolidation right in here. Okay, think market maker buy profile. They don't always go back up and clear the high. They can go up to the bottom of the consolidation and then resume going lower. So one more thing, you have to weigh. You can't just say it's always this way. You have to weigh these things. Okay. So we had a big range expansion on Tuesday. So what happens on Wednesday? Well, take it in context. We're back at the central consolidation that starts the buy profile. So now because you're over there, the flout, it comes 1, 2, boom, 2 deviations up. Okay, it's a reach for reversal. There's your second template. Reach for reversal. It's going to have 2 deviations. If it's got a high impact news event, it could go 3 deviations up, and then it'll go in a reversal or consolidation. We've done both. Went right up to the pip, right in here, and traded softer. This is the reason why I said yesterday, pay yourself. Look at the time I sent that tweet. It's right when it happened. Okay. The old high, okay, that we moved back into, that 144.45 is an old daily high. Look at that on your charts, and you'll see all these things start to dovetail real handsomely. Okay. And having these ideas highly focused in on Tuesdays and Wednesdays, you'll never need any other trading setups. You're going to see a lot more and you're going to trade more, obviously. But you're not going to need to trade every single friggin' day. Believe me, I did that stuff. It burns you out. Even when you're making money, it burns you out. It burns you out. You get so addicted to trading, it becomes gambling. Even though you're doing it proficiently and you're doing it profitably, you start developing a gambler's mentality because you're addicted to that win. You want more of that when you need to be getting addicted to following the process and sticking to that. Be addicted to doing that. Be addicted to sticking to a process, being content, okay? Being content with consistency. Why the hell do you want to push your luck when you're able to be in sync with the marketplace? You're in sync, man. You are absolutely right with the market. You're not beating it. You're in line with it. So once you get that groove, Why would you want to overstay your welcome? Because eventually it's going to kick you in your ass. Trust me, it does it all the time to me. Every single time. After 23 years of doing this stuff, as soon as I think I got it licked and it's going to be perfect, I know exactly what I'm going to do today, I still can get a loss. I can recoup that loss that same day or the very next day, but it's still on my record. I took a loss. I was wrong. I was human. But what will happen is you'll get pissed off. You know, you got a 50 caliber rifle, okay, and you took a, a flesh wound, okay, you took a little bit of a loss. You're gonna get pissed off. You're gonna show the market, you know, what you're made of. You're gonna go and you're gonna take your money back with interest. These are all things I've said in the past too. And there's other times where I've done that and I had my whole arm ripped off where it was just a flesh wound first. I go, I leave the market for the day, I'm losing one limb. I took a bigger hit than I wanted to because I was pissed off. I got emotional about it. See, when you start breaking the markets down in a very objective way like this, the market's bullish based on bearish dollar. It's going to be bearish until the dollar hits a specific level. And we wait each time when it gets to that level. Are those things unfolding in our pairs, like we have cable here? Are we reaching a resistance level? And start pairing those ideas, and you won't be expecting explosive upside moves when it shouldn't happen. You won't be expecting reversals when there's more room for it to go up. See, all these things have to be weighed in balance. And then when they have an agreement upon one another and time, it's time sensitive. So if it's time of day sensitive and day of week sensitive, you got a system. Whether you want to agree with it or not, that's a system. It's designed around predisposed, predetermined, calculated processes that you're going to do based on specific stimuli that you get from the marketplace. This means that I'll do this. That's how your trading is going to become. And it's going to be robotic. It'll feel stilted after a period of time, and then you get bored with it. And that's exactly where you want to be. You want to be bored with it. You want to know exactly what you're going to do. You're not going to be hem-hawing back and forth. Well, should I do this? Should I do that? Should I buy here? How about if all right, I'm going to wait. You're not going to do all that. You're going to know exactly what you're looking for, the setup that you want to trade. And guess what? If it doesn't come, you didn't trade. And you're not going to feel bad about it because you are going to be addicted to the process, not the profits. The profits, they come and go. Okay? But the consistency, that has to stay. Because if that doesn't stay constant, your ass is gone. You are going to lose money, and to the degree where you're going to blow your account. And regardless, these tools, believe me, you can lose all of your money really quick. Believe in an idea because of anything. And my stuff's not. It's not. You know, you're not protected because ICT's name's applied to it. Anything that you arrive at a bet on, because that's what you're doing. You're betting. You don't know for certain this is going to happen. I don't know for certain. It's just a high probability that this is what the algo is going to probably reach for, sweep into, draw liquidity into, neutralize open liquidity, get individuals on the wrong side of the marketplace. These are all ideas that frame the context of what you're trading. But it all goes back to technicals. The technicals give us the basis or framework to hinge those opinions and ideas on, but you're not going to always be right. So you have to have that gray area established. Give yourself permission to be human. Don't trade every single day. Trade when it's highly selected, highly probable that these phenomena is going to take place. If you would have had just 50% of the daily range on Tuesday, that's enough. Now, I already know it's not enough for most of you, but it's enough. It's enough. You can do very, very well with very little, consistently over time. So, let's move this on over to Euro because I jawboned and it already went up and hit our 114 level. At the beginning of the week, I said that we would probably see, if we take out the high on the daily chart, we would see it trade up into the 114s. And today, we breached the 114 big figure here. Okay. And the same premise we have in cable we have here as well. On Tuesday, we expect what? A buy day. Okay, we had the flout, one projected range down. Okay, this feed falls just a little bit short of it. Nonetheless, this is how far we're looking for it to reach for. Okay, you're going to add 3 deviations above for your standard buy template. And you watch this unfold via Twitter on Tuesday. Buy day came back down, gave a New York session reaccumulation, bought it again, rallied up. This is where you would expect to see the daily range fulfilled, right in here. Okay, 1 deviation down, 3 above. Take some profits there. You don't know if it's going to continue higher. So as it presses on, we had Yellen talking, or Yellen. You project one more, there's another objective. If it runs there, take a little bit more off. Ultimately, boom. That's the reason why I sent that last tweet. That's the daily range, bang. And I think it did, what, 3 pips above it beyond that, and then went sideways. You don't get that kind of stuff with pivots and all this other mumbo jumbo. Okay, I don't know it's going to go to that level in London. Okay, so put that shit aside. I'm not ever going on the internet, okay, saying I know where the high and low is going to be before it happens. But I can map it out as the daily range is unfolding, especially once after New York session posts and it's a continuation, or I see what I anticipate as an update unfolding in New York. I can build out this idea here, and you can see it's not contrived. It's not torturing the data. You can't see this stuff on a week-to-week basis and not quickly agree with this is exactly what's going on. And it's been in your charts the whole time, but nobody sees this shit. Nobody pays attention to it. Why? Because we're told trade between these trading hours. Trade at this time of day. Follow this indicator. And they're all red herrings. Look over here when right in front of you I'm doing the misdirection. Wednesday, same phenomenon we had in cable. Starts right out the flout, doesn't come down below it. 1, 2, reversal reach, goes like 2 pips above it. There you go. When we went to reversed and consolidated, and then we went back into another buy day for Thursday, reaching our higher objective 114 level that we called at the beginning of the week before trading. So now I'm going to counsel you and ask you a simple question. Is this going to be easy for you? No. Is it going to be expensive? Yes. It's going to require you to believe that you don't have to be perfect, when that's what you're really looking for right now. You're looking for the perfect, I can't lose, I only want to trade that way because I can't take the risk. And you know why you feel that way? Because you know the opportunity's there to make money. You see it. There's consistency behind this stuff. You may not be consistently applying it and seeing it, but you can see there is consistency behind these tools. So what your mind is telling you is go for broke. Put a heavy leverage trade on. It has merit, but when you put the trade on, you're pissing yourself. And it ain't even moving. You put the trade on, you're under the water just by the dealer spread, and maybe it went one more pip below it. So you got 4 pips drawdown. You're looking at it, you're hyperventilating. You can't eat. You can't talk. Nobody can talk to you because you're worrying about that trade. I know what that feels like, man. I know exactly what that feels like. And you know what the answer is? Your leverage is too high. You don't want to hear it. That's not what you want to hear. You're not going to get rich doing that. That's wrong. You are going to get wealthy doing it. But you're going to be able to trade in a comfort level that is necessary for you to do these things objectively. You're not going to second guess your trades when you know if that trade is a loser, it didn't hurt you. But when it's consistently right, okay, and you're risking 2%, 2% with a realistic stop loss. If you're, I don't know, just say it's a 40 pip stop, not even 30, say it's 40. But if you can capitalize on a daily range of 80, you're 2 to 1. You can get real rich with that. And if you do one shot, one kill, 40 pip stop, 120 pips weekly haul, if you catch a weekly range, 120 pips is not hard to make. It's not hard. You can do 400 to 600 pips every single month. Very, very easy using what I've shown you already. None of you are thinking like that. You're all thinking, give me the best low and high of the week. Because you're looking at it wrong. You got to take some things and say, okay, this is what I believe I'm comfortable in doing. And I don't want to risk too much. But if I'm going to risk 2%, 2% I can live with if I lose. But I have to have better than 3 to take that trade. 3 to 1, 80% statistical probability that the setups are going to pan out based on how we break the market down. 3 to 1, 80% built in. What are you looking for? 6% a week. Not 40. Not 100% return in a month. 6%. That's what you can realistically do if you can frame your trades how I describe it and teach it, and not trade every single day. Really wait for one good setup based on the highest time frame premise, directional bias that we've been talking about all this week. I further illustrated how to do that again here today. Time of week, day of the week rather, and then time of day, coupling that together. You arrive at a very objective way of interpreting price action. You're not imposing your will. You're not crushing the numbers and torturing it with indicators that mean absolutely nothing. You're just following price. You're looking at where the liquidity rests right now. Is it above the market or is it below the market? And if it's above the market and we're bearish dollar, that's a loaded deal. It's just a matter of time how long it's going to be before it starts going up. It may need to take out some stops. It may need to go down below the market first. And don't think that it's all hell and it's going to go straight down and it's done. It's over. Because if you think that way, you won't go back in thinking that there's still good buy signals. There's time in the week. The weekly objective we had, 114s, we saw it today. It's Thursday. But the problem is, and tell me if I'm wrong, when you put the trades in on Monday and Tuesday, you want the weekly objective the day you got in the trade. You forget all about how long it takes for the weekly range to fulfill. It takes Friday's close to do it. Between Sunday's open and Friday's close, that's time that your ass has to submit to. But if you're honest, you really aren't submitting to it. You're not doing it. How do I know that? Well, the emails tell me. The tweets show me. Some of you that I talk to, the silence speaks louder. You have to submit the time. And the easiest way to do that is to deleverage. Don't have any leverage on. If you have $1,000 in your account, you should not be trading one mini. Don't do that. Okay, don't even do that. Trade in such a way where the risk is so absolutely minute that you ain't worrying about it. Because you're not worrying about making the money either, because that's the other side of it. You're not worrying about making money. You have to get comfortable with these ideas and concepts. And until you do, making money is going to evade you. Because all it takes is one string of winners and you're going to think you got it cracked, and you don't. You're going to feel what it feels like to be in a larger trade because you have higher equity behind it, and then you think you got stomach problems now. Just getting in the trade and seeing the dealer's spread, okay, and then standard static price action move against you, you're going to want to get out of the trade, and you will. And then it's going to go in your favor. And you're going to look and see, if I would have held this thing, if I would have held this thing, if I wouldn't have got scared out, if I wouldn't have been afraid to take that trade, when you, all the answer really is cut the leverage. No one's forced you to take that trade. But guess what? You can buy the opening price at 0 GMT on bullish days, deleveraged, and still capitalize on the daily ranges and be wrong, sometimes 30, 40 pips of drawdown. Is it going to bother you? No. But you'll learn daily range engineering with that. Think about it. I talked about that on baby pips. I said, think about it. Go in there, trade, arrive at an idea that you're going to be bullish or bearish for a while, okay, for a week, okay, and you're going to buy the opening price, and you're going to use a 100 pip stop loss and see if you don't have a net gain at the end of the week. You do. Don't take my word for it. Challenge yourself with it. Go and study it. There's absolutely no reason why people are not profitable trading. But your biggest barrier is the person you're seeing in that mirror. Because you're trying to form fit these ideas that your ass has no business doing. You're learning how to be a trader, but yet you're going to tell the market what it needs to do. It has to do this. It won't make sense otherwise. You just started trading. You're gonna say what the market should do? You're not. But we have these ideas, especially as Americans, because we're all pompous, arrogant assholes. It's going to be our way. Have it our way. Our way trading. If I had a brokerage firm, that's what it would be. Our way trading. And I guarantee you the place would be filled with money immediately. Have it your way trading. Sorry. Doesn't work that way. So you're going to have some flexibility. You're going to have some submission to time, a lot of that. And I told you from the beginning with that P word, patience. Very, very expensive. Very, very expensive. But given time, you'll get this stuff. You'll finally wake up one day and say, you know what, I'm bullish dollar. So I'm going to be looking to sell only on Tuesday and Wednesday cable and fiber. It'll make sense to you then. You won't worry about Aussie yen, dollar Swiss, euro yen, Aussie Kiwi. You won't be looking at all these crosses. You're going to look exactly inside the majors. Euro USD, British Pound USD, Dollar CAD, Aussie USD, Kiwi USD. That's where the money's at. It's where it's at. If it's not linked directly to the dollar, you have further amplified the likelihood of you being wrong. Because now you have to weigh a lot more factors that isn't necessary when you're trading majors. And for those guys that are trading in the US, if you're thinking you're going to be in this long term and you want to be doing it long term, you know, by trading those crosses, you're not going to have the benefit of tax treatment that you would want to have if you understood. If you're a profitable trader, you're not going to get those benefits if you're trading things outside the majors. But you don't learn this stuff on the forums. You don't learn this stuff from the gurus. But you learn it from people that's been doing it for a long time. But nobody likes to listen to those guys. They show me the one-shot wonders. Give me the indicators. And the guys that are extremely wealthy in the world don't use those things. They use their brain. And I'm thinking on the charts, where all of you are trying to buy and sell. Because what you guys are buying and selling, I don't want to do that. I want to do the other way. I want to go opposite to that. And I'm not trying to talk down to anyone. I'm talking as general rule, new traders have an uncanny ability to be wrong a lot. And I was on that same curve once my initial luck wore out in the 90s. Every single trade I got into was a loser. Every single one. I could not get a commodity trade to make me any money because I did not know at that time how to trade. And every loss, I put more on the next trade. And I got pissed off and more behind the next trade. And got pissed off and more behind the next trade. And suddenly I was losing airline pilot salaries in a week. Yeah. Try walking around acting like it's all put together still when that's going on. It's hard. It's really hard to do. And eventually it takes its toll on you. And all those things are completely avoidable. You have to submit to your own development. If it takes you 6 years, so what? Where else are you going to be in 6 years? At least you know where you're going. At least you're moving towards that goal. I'm a break-even trader, Michael. I can't make any money. It's pissing me off. You know what I see? That's opportunity. Because if you're not losing money, you're consistently staying around the unchanged mark, you got what it takes. You have what it takes. Because you're not straight down. You're getting some when you lose some. All you need to do is fine-tune a couple things. So if that's what you're struggling with right now, be excited. There's no reason for you to be upset. There's no reason for you to be upset. Think about it. You all want to be surgeons in price action. You got to go through med school. Then you got to go out and work next to doctors before you start picking up a scalpel and making a carving of your own living. Doctors, surgeons, lawyers, all these professionals, they go through school and they go through drills and classes they don't want to go through. They all want to get out and collect that paycheck. And you're no different. You want exchange for the time you have in front of the charts. And it doesn't work that way. But those same individuals that go through school, they are book smart. Because all of us are book smart. We all know what an open, high, low, close is. We all know what a candlestick is. I don't know what the hell a Heikin-Ashi bar is, but nonetheless, we all know a general foundation of information. But why is it that we are so widely dispersed in terms of results? Because the ones that are killing it, making money, they know exactly what they are going to do. Everyone wants to go in to be a surgeon. And then while they're going through school, they focalize and centralize and direct their form of surgery into one path or another. Brain surgery, heart surgery, bladder surgery, general surgery. They become what? A specialist. With my concepts, I force you to be you're a specialist. One way or the other, you're a specialist. You're specializing in buying and selling on Tuesday and Wednesdays at London Open. You're looking for a higher or low to form. You're waiting for a daily range to unfold like this. You're going to wait for it to form by this specific time of the day. You're in med school. You just got to submit to it. It's all part of the process. If you lose sight of the big picture and you get so ingrained and so worried about the near-term adversities and struggles, you're learning. It ain't supposed to be easy. If it was easy, everybody would be doing it. The fact that you're still listening to this message and I haven't told you a trade yet is a testimony that you have what it takes. You believe in it. You're not believing in me. That's not what you're believing. You're not listening because you believe in me. You know what I'm saying is exactly the truth. You're struggling because you're impatient. You're greedy You want to make money right now. I understand it. Some of you have some hardships. You want to get out of your job. Some of you need to make the money because you can't make it right now. Guess what? You're not going to be a trader doing that because you're already going in emotionally. Your psychological mindset needs to be isolated from money. And it doesn't make sense. It doesn't make sense that that's how it has to be. But that's exactly how it has to be. I do not worry about money when I'm trading. I'm not worried about how much I'm going to make. I'm not worried about how much I'm going to lose. I'm worrying about, am I doing what I'm supposed to be doing in this trade? That's where my trading has evolved to. Where in the beginning was, how much money can I make on this trade? Think about that. You do it. How much money can I make on this trade? So what you just said is, it doesn't matter how much I got to risk. I want to know how much I can make. That's what that statement says. And when someone thinks that way or says it, that's a clearly out of control, impulse driven trader that will not have longevity in this industry because he's a cowboy or she's a cowboy and she's swinging for the fence or he's swinging for the fence every single way. And it's not going to work out well for you. Okay. I'm going to take a 5-minute break, get something to drink, and then we'll come back and get on to some of the more specific things. Okay, folks. doing an audio check one more time. Checking Twitter. Gotta reboot my phone. Sorry, guys. If you've responded already. Okay, thank you for that. All right, let's get back to business here. Bring this to a close. So we have today's trading. Squish this over a little bit. Okay, so we have fiber breaching our 114 level. We were looking for a move possibly up to 114.20, sweeping into it. And hang on one second, my wife is texting me. Sorry. Real life, man. It always gets in there. Okay, sorry about that. The problems of live broadcasts. This is what happens, guys. Why I like to go and do pre-recorded stuff, because this is the type of stuff that goes on all the time. You just don't ever hear it. Well, sometimes you do. It depends on whether I do a good editing job or not. But most of the time, that's what I'm spending most of the time getting all that stuff out of it. All right, so we have Euro. We have two deviations up into where we're at right now. Time of day is 10 o'clock in the morning. Okay, ready to the pip. We have cable, softer but trading off of the order block we were talking about earlier. Let's draw a line on it. Drop down into a 15-minute time frame. Okay, believe we had one more. We're inside a large order block with this line on the hourly. So now we're going to fine tune it down into the 15-minute bullish order block. You see rate here. Okay, price hit that here. We're still in New York. Overlap on London close. We have a short-term high in here, so there is liquidity above this high, and we have an order block here. So we have a willingness to want to see price be pulled up. Everyone still sees the London low in here, so we would watch this one and see if it wants to run and take the stops here intraday. If we don't see any kind of slowing down here, we would watch to see if it goes through this bearish order block, and overall liquidity is above this high. So our reference points are here and here. There's where liquidity is, and obviously the high that was formed early in part of the day. So I promised you a discussion on Euro. I'm sorry, not Euro. Kiwi, Aussie, and Yen pairs. And before I go into that, by the way, we just breached the 50% of the order block here. Stabbed through it. Nonetheless, we hit it. So there you go. Nice objective. We had this in our charts before the fact, so that's nice. What was I going to say? I was talking about Aussie. Yeah. So we have Aussie. Be better if I did a Virgin chart. Let's do that. Now, again, before I get into all this business, the ideas that I'm going to share here are intended to obviously stimulate your thought processes. If you're going to trade Asia, you're doing it on your own discretion. I'm not advising you to do that. Okay, just like everything else in my tools, they're just there for informational purposes, and you decide what you want to do with it. But practice in a demo account and prove its worth to you that way. Before we get into the nuts and bolts, I just want to remind you that we talked about the Aussie needing to go immediately up from the opening on this week, and our target would be running the old high here. We did that yesterday. It's still doing it today. It was all based on this bullish order block. It's all in video on YouTube. Okay, so it's all before the fact. Now, yen pairs, Aussie and Kiwi, they have a tendency to do things differently because the quote-unquote new financial day starts in Wellington. Okay, and New Zealand starts today. We got Australia, then we got Asia, then we go into Frankfurt, and then Europe's open, Germany and such, and then we have UK, and then we have Asia closing, then we have New York's opening, and then we have London's close, and then we have New York's close, and then it starts all over again in Wellington. Okay, so that's the sun around the globe following the financial markets. Okay, well, if the new quote-unquote financial day, that's not how I define it, but the new financial day for New Zealand's and Aussies is around 5 o'clock in the afternoon, my time in New York. So the idea is if that's where their opening is, that's when their business day is starting around that time, we have to have a time of day referenced before it. Okay, so think of it like we do with the fiber and cable. Okay, we like to look at the midnight candle in New York. Okay, it's generally 2 hours before the fireworks start. Okay, so that means that around 3 o'clock in the afternoon in New York time, you want to be focused in on that specific time of day and having that range between it and the opening of, say, New Zealand and Aussie, or 5 o'clock in the afternoon New York time. That range is very similar to what we see for how we trade the euro and fiber. Okay, and let's take a look at a 15-minute time frame. And I'll give you some examples of what that looks like. Now, again, I'm not a very big Aussie trader. I don't like trading the yen pairs, clearly. I just don't trust them because I think they're manipulated way beyond what would be reasonably expected. I think this is going to punch up through this high here, but it's not the topic. The topic is something else. We're going to look at this little indicator here, and I know I said I was going to put this on the website, but I hadn't done it yet. So I know, I'm deserving of all the torches and staffs being erected against me right now, because I said I was going to put this indicator on my channel, make it available to you. But one of the subscribers in our group, Kate, was nice enough to send this little indicator here. And what we're going to do is we're going to change. Well, first we're going to change this because I always forget to do it. That's going to make the rectangle appear. Oh, look at that. Hang on one second, guys. I got to grab my power cable. Unprofessional son of a bitch, you know. Okay, sorry about that, guys. Okay, make a change to the color, just not that, like. There we are. Now I'm going to give you a range to start with, and we're going to fine tune this as we go. Okay. All right, so I have here on Forex LTD MT4's demo account. Okay. Now I get a million questions a week about what time of day is it this and my platform is that. Please, please spare me that, because I'm telling you, I've already been on record saying this a lot. Time, as it relates to everyone else around the world, when I'm talking to them, is a big form of confusion for me. Okay, because I don't really have the patience to keep up with where you're at and break all those conversions down. So, at the risk of sounding egotistical or self-centered, it is what it is. I mean, this is how I trade. You got to reference everything I'm saying in form of New York time. Okay, so New York time, we want to be looking at around 3 o'clock in the afternoon, New York time. So it will shift in and out based on daylight savings time. So you still have to have a little bit of a fudge factor built in. Okay, some countries follow daylight savings time, some countries don't. I generally have found out by experience that if I just allow myself a little bit of a wider time window, I don't need to worry about it. And you'll see that the time and price studies that we do, you'll see that it's not that big of a deal. You're not going to lose any sleep over it, like I did for a number of years worrying about it. I just finally got to the point where I don't worry about it anymore. So we have a range established each day, okay, and it's a form of reference, and just so we can keep things germane and on point, let me put right now we're at 10 o'clock in the morning, and for this feed, for LTD, Forex LTD rather, it's 14 GMT, okay, 14 GMT for this particular feed right now. So 10 o'clock will be 11 o'clock is 15 GMT. I can quickly lose. The 11 is 15, 12 is 16, 1 is 17, 2 is 18, 3 is 19. So 19 GMT we set our rectangles to. Now, once you have all these things set up and you want to trade these, then you can clearly create templates for specific pairs like we're describing here for yen and Aussie and Kiwi. Okay, and so by having this, what it does is it gives you the same ideas that we share with, like we were just describing with the euro and the pound. You can do standard deviations. Okay, now you're always going to be inside of the same day with this. But this is what you're going to do. You're going to plot it, expand it up. Okay, and that'll give you what to reach for there. That's a little bit higher than it needs to be, but it's just a hair, so I'm not worried about it. But that's this is a standard buy template. Okay, so filling the numbers, you got one deviation down. There's your buy, and then 3 deviations up, which is unfilled yet. We're inside of the, we went midpoint on the second deviation above. But there's where we'd be looking for Aussie. It would be 77.35 to 77.40, thereabouts. And all we're doing is taking the numbers that we would arrive at by the ranges, and then fine tune it to 5 levels or small round numbers. And that's it. The same thing you do here, you do with the yen and Aussie. My little ones are wanting lunch, so we're going to have to bring this on home now. And again, you're not trying to get every single day, high and low. You're looking when it's most probable, Tuesday and Wednesdays. Standard deviation, 3 down, 1 up for a sell day. Okay. Above, draw in liquidity, distribute expands down 3 deviations. Okay, right from the flout, it would go straight down here, and where we're at today. I'm resisting the urge to talk about certain templates, so I'm also going to have to close for that reason too, because I'm going to end up talking about things that would easily take us into another 4-hour discussion. And admittedly, I'm out of gas today. I'm drained. I haven't eaten breakfast today, so I'm kind of wore out. And plus, my little ones, they're wanting lunch because they ate before I got up. So looking at what we have here, the same thing would occur with the kiwi. And then we'll close it. The the idea is just to get you where the range on the day should expand to inside of the premise that you've already hopefully have established. And the deviation you'll see in these is going to be largely related to the deviation in price feeds that everyone will have, and you can't escape it. Okay, and I'll leave it for your study. You can do all the expansions on each day and see how they unfold, and you'll quickly realize that there is a, like I said, it's a method on how the price engines are driven above and below these times of the day to draw in liquidity, okay, or neutralize liquidity. I'm sorry, liquidity in that area for that particular pair or asset class. Um, over the years, when I was teaching this to folks, I graduated from an infantile stage of understanding, and then finally, over the last 8 years, have refined it a great deal. And by having shared over the long period of time some of the things I teach, some of the things I've traded with, okay, the the beginning of it all, how it all started, was having the midnight candle. Okay, if it trades 10 to 20 pips above the high on that candle, and or 10 to 20 pips below that candle, that's where I would start hunting for stop rates. If I was bearish, I would look for a move above that candle. Okay, and I would look for a move below that candle if I was bullish. And by having all these things worked out over a long period of time, um, you can see on the internet some of the things that were shared by me in this early stages. One of the truest forms is the guy that puts out how to beat the market maker. I mean, that is like right out of the binder. Okay, I mean, you can't change it any more than what, I mean, sorry, you can't keep it any more closer to, except for put my name on it. I mean, it's disgusting, but nonetheless, you don't see what you're learning, with the flout. You're not looking at central bank dealers range anywhere else. Okay, I kept that for all this time. I've never shared it with anybody else. I've never, ever, ever shared that with anyone else. The only thing I ever sat down and talked people with was looking for 20 to 40 pip deviations from Frankfurt. Okay, that's how I did it. And folks on the internet have taken it. They've done things, and there's a guy out there now. He does the ebb and flow of the marketplace, and he has stop run boxes above and below the marketplace, uh, which comes right out of what I discussed. So um, again, all I'm doing is telling you where I got it from, how I developed it. If it was somebody I could credit, I would love nothing more than to be able to say, go over here, learn from him or her or them. Okay, but I can't. So if I say it's from me, or if it's mine, I mean it. It's not anywhere else because it's not anywhere else. I spent a lot of money. I've probably spent about $250,000 over my whole entire trading career, buying everything that most people have either thought about buying or bought. And I can tell you, most of it's bullshit. The only person that I've ever seen that has any validity to behind the teaching of it, like I said, and it's always been, it's remain constant, is Chris Laurie, and that's the reason why you'd only see me paired up with an event with someone like him, and that's what we're trying to put together for 2017. So I'm going to leave you with this, and I'll let you study it and come to your own conclusions as to its validity. But you're looking for 9 o'clock in the evening time, New York time, to 3 o'clock in the afternoon. So, no, it's 3 o'clock. I said it wrong. 3 o'clock in the afternoon to 9 o'clock in the evening, New York time. That's going to build your flout for the yen pairs, the Aussie pairs, and the Kiwi. And you can still use the standard one we use for euro and cable, but I like to use these specifically for those yen and Aussie pairs. So with that, guys, I'm going to wish you good luck, good trading. If you're in profits, I would take them now, move to the sidelines, and enjoy the rest of the week. We do have conditions that would, in my opinion, present some unfavorable opportunities. So bank what you made. Congratulations on those that have killed it this week, and I wish you good luck and good trading.